It's been a slow start to the year in venture capital deals with bank defaults, still high inflation, and an uncertain economic environment forcing startups to be more realistic about their growth prospects and pushing funders to be more choosy about what they invest in. So let's learn more about 2023 in deals. Don Butler, Managing Director of Thomvest Ventures, and Kyle Stanford, PitchBook Senior Analyst, joining us here today. Thanks so much for the time, guys. First and foremost, Don, when we think about the holistic environment that we're in right now and the appetite for deal making, what are you hearing among VCs?
Well, I think, it's something like the appetite is there, but the ability is not necessarily there right now. I think what you're seeing is a lot of firms are triaging the portfolios that they have today. And then I think as we've been coming through that wave, the next thing they're doing is that I think they're also triaging their own funds. And, in this sort of uncertain environment, what we're starting to see is funds looking out and saying, well, gosh, I might have been pacing myself too quickly. And if I need to slow down my pace to get more vintage years, that's going to slow everything down. And at the same time, if I've got my eyes towards raising my next fund, I've got to think about what are the assets that I save to do that. And then secondly, on my own team, like on my own venture team, who's going to go with me for the next fundraise? And so we're seeing a lot of kind of two waves of triage happening in the funding environment.
Yeah, and the triage is reflected in the numbers we were just talking about, which is from a report that you guys came out with on the first quarter, sort of state of VC right now. Things don't seem great. I guess the headline number, or the headline for that. But what sort of stood out to you as you guys were piecing through the numbers as particularly acute areas, or is it just everything?
I mean, really everything. But when we look at what's probably most important for the venture market, that low amount of exit value that's being generated is going to cause problems down the road. Right? We have a huge number of unicorns. We have a huge number of companies that have raised these high valuations in 2020 and 2021, but are unable to get liquidity, and they're also not finding the funding they need. These companies are large, relatively well developed. They need huge amounts of capital, and that's not there right now. We huge pullback from the hedge funds and mutual funds, and they are really pushed a lot of money into the market right now. And so these companies at the late stage with no exit market are really sitting in a tough position.
What type of companies are we talking about that are still getting funding, even in this environment? There's been a lot of talk about what health tech, the future of healthcare could look like with a new infusion of technology, or even on the generative AI front because of all of the artificial intelligence resurgence in the chat, if you will.
Yeah, right. Well, so what the investors have done is really changed where they're putting the premium or what they're valuing these companies right now. It's no longer just a sheer revenue growth, like let's see how big we can get this market share. It's how can you create a business that has solid fundamentals, getting close to profitability, right? Profitability is something that's thrown on all the time. It's not necessarily what VC is made on, because you have to be growing, but you also have to have relatively low CACs. You have to be able to bring in more money than what you are. Bringing in more money than what it's costing you to put that product out there. And that's not what venture has been doing the past few years.
Right, that is a big change.
So the companies that are able to show those strong metrics and strong fundamentals are getting the capital right now.
Yeah, I mean, we've seen a lot of cutting at the publicly traded companies, right? We've seen job cuts, we've seen expense cuts of all kinds. Don, is that something that you all are pushing your portfolio companies to do as well? Are we seeing it a lot on the private side?
We are on the private side, but I'd say really there was a first round of cuts that happened last year, and what we're getting is we're sort of getting people's homework graded on did they cut enough, and are they able to push their unit economics in a direction that sort of tells you either one of two things. Either I'm going to drive to break even, or I'm going to drive my overall burn down so much that when I need to do that next fundraise, the next fundraise is not 100 million, it's 25 million, or it's some smaller number that can be managed. That's what we're really seeing in terms of the first wave of layoffs. And then the second thing that we're seeing is some firms are coming back and saying, you know what, I didn't cut enough. And so we have seen a second round of layoffs among certain startups, especially, what I find is it tends to be the ones we've seen, tends to be the later stage ones because they had such large headcount. If you have a 30, 40 person Series A company and you cut 10 people, you've already, there's not much more to do. Right. Yeah. And so I think what you'll see in terms of headlines going forward will probably be more oriented around those bigger companies that maybe didn't cut enough. Because I remember people thinking, well, it'll be Q1 2023 is when the market will come back. And that shifted to, well, maybe Q3, maybe Q4 of this year, maybe next year. So I think the duration of this downturn is much longer than people were initially projecting.
Are we seeing a major shift in terms of the regionality of where these dollars are flowing? Previously, it was, hey, if it's a startup in Silicon Valley, of course we got to look at them, we got to hear the pitch, and we have to at least kick the tires on this. Has that shifted elsewhere in the U.S. now?
Sadly, as someone whose office is right in South Park in San Francisco, I think it has. I think it started to. I think your numbers also showed sort of a shift down from San Francisco. There's still this great hub, and one thing I think I particularly enjoy when we're out there in the city or in the Bay Area is you can throw a rock and hit somebody in the tech ecosystem. Like the amount of just happenstance that leads to people being hired or meeting new customers or investors is something that I don't know if you replicate in other territories. I've had friends who've moved to Miami who say, a lot of people I meet here, don't exactly know what venture is or how the venture ecosystem works. So I think there's still quite a bit of dynamism there, but still go to downtown San Francisco on a Tuesday afternoon and you'll notice like traffic is way down.
Yeah, we got to leave it there, guys. I wish we could talk much more about all this stuff. Thanks for coming in. Really appreciate it. Don Butler, Managing Director at Thomvest Ventures, and Kyle Stanford, PitchBook Senior Analyst of VC. Thanks.